Hey everyone, welcome back to Corporate Decoder. Today, Integrated U.S Small Cap Growth Equity Fund just filed its semi-annual report for the 30th of June 2026, and I am seeing some interesting shifts in how they are managing assets. Quick note, this is not financial advice, just my take on public filings for educational purposes. The fund's total net assets remain massive, but I want to dig into where the money is actually going and how it performed. This is the official report for the Integrated U.S Small Cap Growth Equity Fund. It covers the period from the 1st of January 2026 to the 30th of June 2026. Think of it as a mid-year checkup for the fund's investments. They are telling us how the fund is doing, what it is invested in, and how much it costs to be part of it. Let's break down the costs for a hypothetical $10,000 investment in the investor class of this fund. The costs for the last 6 months were about $43. That is 0.79% of your investment. For the advisor class, it was $58 or 1.06%, and for the I class, it was $36 or 0.65%. So, the I class is the cheapest, which is typical for funds with higher minimum investment requirements. These are the fees you pay just to have your money managed. Now, for some key numbers about the fund itself, the total net assets are a staggering $9,807,517,000. That is almost $10 billion. The number of holdings, meaning the individual stocks or investments the fund owns, is 351. That is a pretty diversified portfolio. The portfolio turnover rate, which shows how often the fund buys and sells its investments, is 47.3%. This means they are not constantly trading, but they are rebalancing their holdings a good portion of the year. Let's look at where the fund is putting its money. The biggest slice, 28.2%, is in healthcare. That is a significant chunk. Next up is information technology at 22.5%, then industrials and business services at 19.4%, financials make up 8.8%, and consumer discretionary is at 8.5%. The other sectors like energy, materials, real estate, and communication services are smaller portions of the pie. The other category is 1.2%. This shows a strong focus on growth areas like healthcare and tech, but with a solid base in industrials. Here are the top 10 companies the fund is invested in. StoneX Group is the largest holding at 1.1%. Then BrightSpring Health Services at 1.0%, followed by InterDigital also at 1.0%, and Moog at 1.0%. Belfuse is 0.9%, and then Esco Technologies, First Cash Holdings, Argon, Belden, and Federal Signal are all at 0.8%. What is interesting here is that even the top holding is only 1.1%. This means the fund is not heavily reliant on any single stock. If one of these companies has a bad day, it won't sink the whole fund. This is a sign of strong diversification. Now let's look at the performance metrics for the investor class. The net asset value at the beginning of the period, the 1st of January 2026, was $44.65. Over the 6 months ending the 30th of June 2026, the fund saw a total gain from investment activities of $9.4 per share. This resulted in a net asset value of $54.05 at the end of the period. That is a significant jump, showing strong performance in the first half of 2026. The total return for this period was 21.05%. That is a really solid return for a 6-month period. Looking at the ratios, the gross expenses before waivers were 0.80%, and the net expenses after waivers were also 0.79% for the investor class. This means the management team did a good job of keeping costs down. Even with the gross expenses, the net investment loss was negative 0.34%, which is also common for growth funds where the focus is on capital appreciation rather than income generation. This is the most detailed part, showing exactly what the fund owns. We can see holdings broken down by sector. In communication services, they hold IMAX and TKO Group holdings. In consumer discretionary, there is Finia, Vistion, and Global. E-Online for energy, they have Archcrock Expro Group holdings and Technif MC. The healthcare sector, as we saw, is a big focus, with many companies listed like Adma Biologics, Alchemies, and Beam Therapeutics. It is fascinating to see the sheer number of companies they are invested in within this sector. Let's pick out a few specific holdings to illustrate. In the healthcare sector within biotechnology, they own companies like Chimera Therapeutics, valued at $65 million. They also have significant holdings in Mineralys Therapeutics and Mirum Pharmaceuticals. For information technology, under semiconductors and semiconductor equipment, they have Entegris valued at $61 million and MKs at $60 million. This gives you a real sense of the scale of their investments. The total value of common stocks held by the fund is over $9.7 billion, with a cost of about $7.4 billion. This means the fund has seen significant unrealized gains on its stock holdings. The difference between the value and the cost represents the profit the fund has made on paper. Beyond stocks, they also have short-term investments. This includes money market funds like the T. Rowe Price Government Reserve Fund, valued at over $43 million. These are typically very safe investments used to hold cash that isn't actively being invested in stocks. This is an interesting part. The fund also invests in a pooled account through a securities lending program. They have over $40 million in the T. Rowe Price Treasury Reserve Fund, which is part of this program. Essentially, the fund lends out its securities to borrowers and earns income on that lending, and the collateral is invested. This is a way to generate a little extra return. This shows that the fund is almost fully invested, with its total investments representing 100.7% of its net assets. This is common for growth funds that aim to deploy capital effectively. The cost of these investments was about $7.5 billion. The report also details investments in what they call affiliated companies. These are essentially other funds managed by T. Rowe Price, like the Government Reserve Fund and the Treasury Reserve Fund. The fund earned over $1,000 in investment income from these affiliated funds, which is pretty standard for cash management. Here we see the fund's balance sheet. Total assets are close to $10 billion. Liabilities, like payables for securities purchased and money owed for share redemptions, are much smaller. The net assets, the actual value belonging to shareholders, is over $9.8 billion. This section reiterates the net asset value per S-share for each class. For the investor class, it is $54.05. For the advisor class, it is $52.73. And for the I class, it is $54.75. This confirms the strong performance we saw earlier. The I class, with its higher net asset value per S-share, reflects its higher minimum investment. This statement shows the fund's income and expenses over the 6-month period. They had investment income of about $19 million, including dividends and securities lending income. However, their total expenses were over $31 million, leading to a net investment loss of about $11 million. This is not unusual for a growth fund, as the focus is on capital gains from stock appreciation, not income from dividends or interest. This is where the real story of growth lies. The fund had a net realized gain of over $1.3 billion from selling investments. On top of that, the change in net unrealized gain, meaning the increase in value of stocks they still hold, was over $390 million. Combined, this resulted in a massive net realized and unrealized gain of over $1.7 billion. This is why the net asset value per S-share jumped so much. This statement shows the changes in the fund's net assets. The big increase from operations, over $1.7 billion, is the key number here, driven by those realized and unrealized gains. They also had some distributions to shareholders, but the growth from investments far outweighed any payouts. The capital share transactions show more shares being sold than redeemed, indicating investor confidence and inflows into the fund. This section is about the fund's board of directors approving the agreement with T. Rowe Price Associates, the investment advisor. They reviewed the services provided, the fund's performance, and the costs. They found that the management fees are reasonable and that shareholders are benefiting from economies of scale as the fund grows. This is standard annual approval for an investment advisory contract, ensuring the manager is acting in the best interest of the fund. The board looked at industry trends and compared the fund's fees to other similar funds. For the investor class and I class, the report indicates that their fees rank in the first quintile, meaning they are among the lowest cost options compared to peers. This is a positive sign for investors. In conclusion, the Integrated are small. Cap Growth Equity Fund had a very strong first half of 2026, driven by significant gains in its stock holdings. The fund is well diversified across sectors, with a heavy weighting in healthcare and technology. The costs are competitive, especially for the I class. The management team's performance and fees were reviewed and approved by the board, indicating a well-run operation. The key takeaway is the substantial growth in assets from investment appreciation, even with a net investment loss on paper, which is typical for a growth-focused strategy. That is my take. Stay decoded.